What do you make of the first couple days of this year? It's been eventful. Certainly, the market seems to have been taken a bit aback by the Federal Reserve balance sheet news. What's your take?
I think this is somewhat expected. I was actually surprised on how strong we finished the last week of December. I think that last bit of rally, perhaps investors are starting to say, oh, we've actually got some headwinds here. And certainly the Fed, confirming that we might see rates as early as March, maybe perhaps is a bit surprising. But anytime we talk about higher rates, you always see a bit of a pullback on the markets. But I think overall, we are in a pretty good position for the year. So the first quarter might be a little concerning. We know that we've seen some of the estimates for the first quarter revised down. We've seen some GDP growth revised down because of this last variant of COVID. But for the year, we're actually seeing profit estimates go up very consistently over the past 2 months. So right now we're looking at about 8.5% growth for the S&P 500, 11.5% growth for the S&P 600. These are good numbers. These are the type of numbers that are profit growth that we've seen back in 2014 to 2017. And those were very good years for the stock market. So though we do have, just like you're talking about, these mega caps that really have a lot of weight, are very highly valued, overall, the fundamentals for the full year look very good for going into 2022.
Well, right now, we've been talking about the Fed and this balance sheet reduction, but you and I know, Aaron, that the financial markets have the attention span of a pigeon. It's not very long. Right now, we're focused on the Federal Reserve. You're talking fundamentals. Do you think the narrative, sooner than later, is going to switch from the Fed, we're all going to get over that shock or whatever, and start focusing on things like corporate earnings and earnings growth?
Well, as an investor, I would certainly hope so. But yeah, look, I think this story of supply chain issues, inflation, the Fed, it's very likely that we're going to see that in the headlines for the first half of the year. And when we look at inflation expectations, we still expect some increases and at very high levels of inflation for the first 2 quarters. And so that's another part of my prediction is that though the full year looks good, I think we're going to see a lot of volatility because these types of headlines around the Fed, around inflation, around supply chain issues, that's going to continue. And so the past 2 years, if they haven't already felt rather volatile and extreme and stomach churning for investors, you might expect that for another 6 months. And so that's where we're trying to.
Yeah, they've been stomach. I would say they have been stomach churning, Aaron, but they've also churned higher. It's like if you can just weather some of these big VIX days, and that's how the market is nowadays. You kind of just chug up, fall a lot, chug up, fall a lot. It's kind of the new market paradigm. When we talk about the Fed, we talk about inflation. Inflation gets a bad name. Inflation can be good for certain types of assets. Would inflation mean pricing power for, say, the small cap, mostly domestic focused stocks?
Yeah, in fact, they could be very positive. The downside is that if interest rates really get higher, they could weigh on the valuations of small caps. Now, fortunately, small caps are already so lowly valued compared to the mega caps. They're actually in a very good position that as long as we get a little more certainty around interest rates, they could really be the outperformers for the year. And so we're looking at that very carefully. I think within the first half of the year, probably we'll still see that continued outperformance within the large caps. And once we get a better and a clearer idea of what the Fed's going to do for the year, that's when those small caps could really outperform.